Welcome everyone. Thank you for joining us for this edition of the Genghis Weekly Investor Briefing. In this webinar, we take you through the happenings of the past week in the financial industry and what we expect in this new week and where you can actually put your money on. My name is Daniel Ogeto, and I'm from the marketing department at Genghis Capital, sorry. And we have our speakers today who include Churchill Ogutu, who is our head of research at Genghis Capital. We also have Gerald Morioki, who is a research analyst, at Genghis Capital. And in today's we are joined today by our guest, that is Mathew Kabeere from Fx Pesa, who will be able to cover the global markets. And I think we can start with Gerald. Yes. Gerald, over to you.
Thank you, Daniel, and good morning, all. Daniel, you can confirm my microphone is good?
Yes, maybe just try raising your voice a little bit. While you're doing that, maybe I can do some housekeeping. Should you have a question, kindly direct it to the question panel in your Zoom control panel, so that we will be able to answer these questions at the end of the webinar. Over to you, Gerald. Now you can maybe test.
Okay, thank you, Daniel. Let me share my screen. So we'll begin with a recap of the equities market last week. Fairly what we observed over the prior week, uncertainty in the market, with the NASI up about 1%, and then the NSE 20 down about 0.8%. So a fairly steady market week on week. However, we saw turnover rise considerably, about 24% to about 3.1 billion. But however, you'll see that this turnover was mainly on a large trade on Thursday. So it is not reflective of the average weekly turnover during the week. So top gainers last week, EABL, Flame Tree, I've already expressed. You'll note EABL as a standout as a top gainer. We usually don't have the large cap stocks in this list of top gainers or top losers on a weekly basis. And we'll definitely discuss more about EABL in our recommendations henceforth. So top losers, NMG, DTB, Sanlam. Again, you'll find DTB there as a top loser. We usually don't find the large caps as part of this list again. So a little bit of some activity on the large caps last week, and then we expect some of this performance to continue during the week. Top traded, Safaricom, KCB, Equity, ABL, the usual large cap counters, and most of these tend to be usually moved by the foreign investors. Foreign markets, foreign activity participation at about 68%, so still controlling the market, and net inflows about 78 million. So we still see foreign investors accumulate in the local market. And last week, we were heavy on Safaricom, Equity, and the ABL. Remember the prior week, inflows are mostly on Safaricom. So Equity and BL made it to the top buying list by foreign investors during the week. Exiting, again, KCB, quite a large exit on Tuesday. BAT Kenya, again, some exiting over the course of last week. And then the top traded foreign counters were Safaricom, Equity, KCB, BL, and BAT Kenya, basically the large cap stocks that tend to have the largest fundamentals. So trading metrics in comparison to our peers in Africa, fairly, on average, fairly bullish market, about 0.6%. think to only Nigeria and Botswana, which were negative. On a year-to-date basis, up about 1.2%, but on average, our market is performing much higher than most of the SSC peers. Market PE 11.4 times against 9.8, so slightly ahead of the African average PE, and dividend yield above 4.3% against 5.3%. So however, you see, despite this being above the African average, we find that these are still quite low compared to the historical PE and dividend of the market. Trading ideas for this week. So long term, you're still biased towards this strong stocks, stocks with the best fundamentals in the market. But our recommendation this week, EAPL, I think I missed that, EAPL. So yeah, long-term buy on EAPL. And we saw from half-year announcements, financial performance is quite good on a half basis. So half-year sales recovered considerably, about 53%. So this is between June, July, and December period compared to the January and June period, because the full year usually ends in June. So you'll find that during that period there was a bump in sales, about 53%, and we expect that by the end of the financial year will be at break even in terms of sales. However, for EAPL, key risks are emerging. The key being taxes. We all know the government is desperate for tax revenues, and we'll find that sin tax is usually one of the easiest for government to target. So that is an emerging area that investors should be aware of. For our other recommendations is basically a cautious strategy on the takeover transactions of Kabasid and BUC. I think we talked about Kabasid BUC transaction last week, and we saw some announcement last week that there's going to be some delay. There's still some court challenges, labor issues that are emerging as a risk towards the completion of the transaction. So we urge investors to be cautious in terms of entry or exit that based purely on that transaction. It's called a merger arbitrage kind of strategy in technical terms. Corporate calendar. Still the same we had last week. Kengen final dividend of 30 cents with boost closure of 29th April. Current General, another final dividend of 80 cents. Boost closure on 22nd February. So we still expect full year earnings season to begin within this month and next month, especially for the banking sector. And I think we have captured most of our expectations in terms of what the sector is going to perform, is going to announce, and dividends that probably will be coming in during the full year announcements. Yes, maybe Churchill could take over from there with macro and fixed income. Thank you all.
Thank you, Gerald. Let me pick it up from here. Perhaps you may just
Churchill, you can just share your screen.
Okay. Churchill seems to have frozen. Stop this.
Okay, while we await Churchill, maybe, yes, yes. We have Mathew Kabeere from Fx Pesa, and today he'll be able to expound more to us about the global markets, key of which being what to expect from now that the Biden presidency has started, what should you expect in the stock markets, in international stock markets, that is? And I see Churchill is now back. Churchill, now you can share your screen. Let's hand it over to Mathew, who will take us through Fx Pesa's presentation. Thank you very much.
Hey everyone, good morning.
Happy New Year.
I'm tempted to say Happy New Year, but we're in February. I think the year is already old enough, but Happy New Year to everyone. It's really interesting to be with you all here to delve into what the markets have for us, the global markets in this case. And as usual, I will start by looking at a few things and just a recap from what I had shared last time. I hope you can see that my screen, Churchill, Gerald.
Yes, you can.
All right, thank you. So the opportunity, the global markets and the week ahead, it's been quite a year, right? And we're in another year. So still want to look at the market cycles. We're still in these cycles. And one good thing is that we're seeing them just to understand what they are. Remember, in the Forex market, you can trade with, you find stocks there, you find currency pairs, you'll find indices, yeah. And it's really interesting that we need to understand the market cycles. Last year was a different one, a tough one, but we still sailed through. And we're getting to another cycle here. Swinging of global markets up and down is what we call a cycle. We have expansion, then we have market peaks, contraction, then the market marking down. Of course, we need to follow up on things like inflation, unemployment, economic and economic growth rates and interest rates. Those are the things that are moving the markets. And when you look at the markets right now, we're coming from a very difficult time. And of course, we're having things about the vaccine helping economies to rise up. Of course, these are things that are really moving the markets. We need to understand them and know the market cycles. And that's the thing that's going to help us know where we are in the markets, because once we understand the market cycles, we know the risk levels in the market, we know the portfolio, and with that, then we know what we can trade. Of course, on risk off times, then of course we're looking forward to downsizing on risky asset portfolios. Yeah, going to safe haven, but that's kind of what we've been doing for the whole of last year. And right now, because of the vaccines and of course having new administration in the US, and of expecting something like the green stimulus, right? So we are now moving from the risk off situation to the risk on, where you can now speculate. The traders can speculate on high risk assets, and of course take advantage of now the calming down of the market volatility, right? And again, look into the side of the stocks. So the global economic environment is something you need to watch, especially when you're on the Forex, online Forex markets, and you need to readjust your portfolio depending with the market cycles that you find ourselves in. It's really dynamic, and that's why we always insist get the right education. Now, with that little sneak peek, looking into last week, of course, RBA held interest rate cuts. Of course, Australian dollar by adding 100 billion Australian dollars to their bond purchase program, and that's has to be implemented to the end of the current program. Bank of England, again, they had some interest rate announcements there, but they held them. All right, pound recovered modestly, and of course, with the indication that the inflation might be going up. So if you were keen on the markets last week, pound really gained something, right? Some really good percentage, was bashing some other currencies, their peer currencies. Equity markets are edging higher. You can see that looking at the Dow Jones, looking at the Nasdaq, we're really getting edging higher and higher, all right? And the dollar index again went up. Dollar getting stronger. Gold suffered because of that, and we also had it was really a very busy calendar last week. We had unemployment dropping for the US, and those are really the news that influenced the market last week. Now, looking at the week ahead, of course, this is how the calendar looks like. Not quite busy, but we have some substantial events to look at on Monday. That's today, Switzerland. That's for the CHF, German industrial production. Tuesday, we have something about the New Zealand and China. And then again, very important here, the consumer price index reading for the US. That's about the inflation, all right? Bank of England, again, speech from the governor and also from the Fed. Remember, we're watching this space, of course. I talked about the green stimulus, and you know that US is just about to give that stimulus. We don't know when, yeah, but that's where we're gonna keep watching, because it's really going to have a big impact on the US dollar. And again, it will give a direction on where the stocks might be moving, and again, the gold, because of course, there will be some inflation, right? If that amount is gonna be released into the economy. So those are the big news we're watching. And again, on Thursday there, unemployment claims. Again, on Friday, keep watch of the economic calendar, and that's where you can find an edge. So we're keeping watch of those events this week. Products to watch this week, of course, here we have Euro USD, yeah, Euro dollar. When you look at the charts there, you can see it's just touched the 1.94, around the 1.94 level, and getting some that after that bounce, testing that level, which is just turning into a resistance, from a support to resistance. And very important is that Euro USD is really following a trend, an uptrend, which started last May, right? If you're able to scan the markets, you can see from a very good support there on 2nd November, around November there, and now we're getting the same this February, and we don't know what might happen, but of course we have to keep watching the fundamentals. So currently, we're looking at the market testing the 1.205 level there. If it breaks up upwards below that level, because of course when you check again with Fibonacci levels, that's around the 38, around the 50 level, right? If it gets support, if it breaks that level and keeps on rising, might go to test the 1.217, and again on breaking that very key resistance level, might see the currency moving all the way to 1.23, right? But if the flip side happens and it breaks below that trend line, which has been holding for quite some time, maybe test and break the 1.9 levels there, we might see it to the downwards of 1.17. So keep watch of it, see what opportunity you can get there. US inflation numbers to be released this week, right? And US economy is already stronger, and actually with a faster, likely expecting a faster recovery. Increased efforts led by the White House, those are the reasons, the increased efforts led by the White House administration regarding the distribution of vaccines, and been a key element for the recent increase in the dollar strength. The planned stimulus package will likely push the US dollar further ahead of the pack, and any signs of rising inflation in the US, of course, will lead to expectations of bond yields rising, which could lead to even a stronger dollar. All right, so keep watching the space. Another very important asset here, that's the gold. Looking at what's been happening for the whole of last week, we had got a very big drop there, right? And again, bouncing back, trying to bounce back around the 1.77 there. So right now, testing again the previous support level. So if it breaks above that region, because even when you look at the live charts, currently it's just testing that level. If it breaks about beyond that level, might be seeing it to test the levels of 1870s, 1860s. But again, what you can see right now is that it's trading before the moving averages, and up until it breaks above those levels, that's when you can think of an upward move. But again, for the gold, it's really dependent on the strength of the dollar. So anytime that you see that we're getting a weakness in the dollar or a strength in the dollar, you know it's really affecting the gold. So again, when you see the stimulus getting in, especially from the US side, might be a boost to the dollar. Currently, against the dollar is what is putting pressure on gold. So on the stock side, top companies to watch this week. Of course, earnings season is still rolling on, and we have a few picks for you here. You can just watch out on Twitter, Cisco and Fox is Tuesday. On Wednesday, CME, Coca-Cola and Disney, Expedia, Commerzbank. On Thursday and Friday, again, we have Roku. Again, just want to encourage you. Let's again try to have a portfolio that's a little bit diversified, not only trading the currencies, not only staying with the majors. Look out for other opportunities on the risky assets as well. Go on to stocks. Check out for maybe the value stocks that you can find there. Of course, Churchill will speak more about the stocks when it's all about talking about the value stocks. They are different, right? But check out what you can see on the stocks side, and you can actually make something out of it. Just something I want to hit for all of us. Since Jumia was added here as an asset that you can trade, if you had an opportunity, if you took that opportunity, you could be making money right now, because Jumia has moved up for up to 400% gains, right? So let's watch out again on the stocks. Might be a good opportunity for us to take. And with that, that's my bit from my end. Over to you, Churchill.
Thank you very much. Churchill, you can now share your screen and present your presentation.
Thanks, Dan. Okay, so I'll take you through the macroeconomic, that's the local and fixed income segment. Just a review of last week, what came out was the Purchasing Managers Index, the PMI for the month of January. We saw it going up to 53.2 from 51.4 that was there in December. So a rule of thumb is that any number above 50 is showing that there's an expansion of activities amongst the private sector. Anything below is showing that there's a contraction of activities. So we've seen that there's been a steady climb with its month's data for January 2021 data. That's the PMI index. Moving on to what's the outlook, this is basically revolving around the fact that Parliament is resuming its sittings from a 2-month recess. So it's ending today. So from tomorrow, both the National Assembly and the Senate are coming back in their normal sittings. And we expect that some of the documents that are usually tabled in Parliament around this time will be tabled either earliest by Thursday in the Thursday sitting, or latest next week on Tuesday. That's 15th of February. So we have the 2021 budget policy statement, that one which was the draft that was out last week, which the public was invited to give their comments on that. And we expect that it has been approved by the cabinet before it's being tabled in Parliament, tentatively by earliest by Thursday this week, or even tomorrow's sitting, or latest next week on Tuesday. We also have the 2021 medium-term debt management strategy, which is also expected to be tabled latest by next week on Tuesday. Also, the quarterly economic and budgetary review, just a look at where were the revenues as at end of last year, how was the expenditure, and also the financing. And attendant to that is now the public debt status as at the end of last year. So that report under the quarterly economic and budgetary review is expected also to be tabled latest by next Tuesday in Parliament, and also to be published on the National Treasury website. So moving on to the fixed income for last week, there was a drop. Last week we saw that this previous week we saw the secondary market activity at a record high. It was around 34 billion. So last week's data, we saw it declining slightly by 38% to 21.2 billion. No-brainer trades were majorly on the 16-year infrastructure bond that was issued in 2 weeks ago, which accounted for roughly 43% of the total trades. In the T-bills, we are seeing that the performance rate was 70%. In aggregate terms, that was 16.8 billion. CBK has been seeking 24 billion on a weekly basis. We saw that yields declined on the 91-day tenor, while on the 182-day and risked 4-day tenors, there was an increase in the yields that was recorded as compared to the previous yield levels. Moving on to the liquidity trends, we are seeing that the average interbank rate declined by 0.21% on a week-on-week basis to an average of 5.4%, meaning that there was some improvement in liquidity in the interbank market. That was also cemented by the fact that in the open market operations, CBK was majorly focused with liquidity mop-up activities. That through the term auction deposits, there was a 4-day, 6-day, and 7-day tenors that were issued over the course of last week, at least to mop up the excess liquidity. Looking at the net domestic borrowing, right now we are at close to 327 billion. That's inclusive of the overdraft facility. That takes domestic borrowing slightly at 57%. The revised target is 57.27 billion in the overall fiscal year. So we are at around 57% of the target that has already been met as at the end of last week. Moving on to also the primary bond auction results, whereby the governments, rather the fiscal agents, sought to pick 50 billion. Total bids received was 41.9 billion, which was more or less in line with our expectations that we weren't seeing any positive appetite for these two dual tranche papers. So the total bid received was 42 billion rather. And the total bids that were accepted was 32 billion, so roughly 10.8 billion was rejected. Looking at the specific issues, the first one, which was the 15-year paper that was issued in 2013, it had a coupon rate of 11.25%. Bids received on that was 13.6 billion, of which 9.4 billion were accepted. The weighted average rate was 11.784%. So comparing with coupon rate, it's telling us that that paper was issued at a discount because the yield is higher than the coupon rate. So the price is at a discount. So for every 100 shillings, as an investor, you will primarily invest into that bond, you are paying less than 100 for that. So the dirty price. So the dirty price, by dirty price, I mean that is the clean price. It's rather based on this the syllogism that if the weighted rate, or rather the yield, is higher than the coupon, in this case 11.784% is greater than the coupon rate of 11.25%. Now the price is less than 100. It's less than 100. But now the dirty price is now you have to increase an accrued interest portion. Bonds pay coupon rates, coupon payments every 6 months. So right now, because this were reopening of papers, it means that before this auction, there was a previous coupon payment that was made. So based on that accrued portion of since the time the last coupon payment was made up until today. So as a person who was getting into this bond, you had to pay that accrued interest. So you're finding that the dirty price inclusive of the accrued interest was coming to 102.9 for every 100 shillings as an investor. So the next bond was at the 20-year bond that was issued in 2012. It had a coupon rate of 12%. And the bids received was 28.3 billion. So there was a decent interest in this paper just because of its higher coupon rate of 12% vis-a-vis the previous one, which was at 11.25%. The bid accepted on this paper was 22.7 billion. And the yield that was accepted was 12.587%, which was higher than the coupon rate. So it's telling us that this paper was at a discount. And you can see, even inclusive of the accrued interest, it still is below 100 shillings, which is at 99.17. So in absolute terms, we are saying that as an investor, say if you have 100,000 and you want to invest into the second bond as of today, you'll have to pay a 89,170 shillings. The previous one, you'll have to pay 102,900 shillings at least to get into these two papers. Finally, we are looking at the week's trade, seeing the moves in the infrastructure bond paper that was issued a fortnight ago. We are seeing that at least there's some capital appreciation for investors who might want to exit in this bond. So our week's trade is now a sell at 11.5% to 12% levels. We've seen that there's been a record demand in this paper in the last 2 weeks of secondary trading. So for investor, perhaps if you had entered into this trade during the auction, you can either exit or you can reduce your holdings at least to get that markup based on the demand that you are seeing on this paper. So let me stop it here and hand it back to the next session.
Thank you very much, Churchill, Gerald, and Matthew for the presentations today. Now you're going to tackle the questions. Now, first is Kamau asking, Naushad Merali is buying more of Samia Africa shares. Samia is divesting into real estate, while what does this portend to the counter? And then the second question is, why does NMG shares fall despite massive investment in the digital space? Gerald?
Yeah, thank you. Thank you for those questions. In terms of Samia, I think that is not new info about venturing into real estate. I think they announced this change of strategy from the battery business that we all know, no, not battery, tires, sorry, I'm talking about it already. Sometime back in 2016. And when you look at the history since then, in terms of financial performance, I think it is yet to show, their angle and, how successful they can be in that side. I think it's going to take a little bit of some time, because when you have to overhaul your business, to venture into an entirely new kind of industry and business segment, I think it may take some time for you to start monetizing on that strategy. For
the second question
NMG,
was
NMG, yes. In terms, yes, Nation Media. Yes, so yeah, the business, the digital strategy is something they talked about, I think, for almost now thank you. For almost now 3 years. But I think we are yet to see how good they can be able to monetize that digital strategy. I think the business is still, most of their revenues are still heavy from the print division. So how the digital strategy is going to pan out in terms of monetization, in terms of scaling it up, I think is something that is still out there. However, I wouldn't say that that is the reason why the stock dropped last week. We all know on a short-term basis, there's always that kind of volatility. However, for the fundamental side, I think we are yet to see how good they'll be on the digital transformation that they have talked about over the last 3 years. Back to you, Daniel.
Yeah, one more question for you. Safaricom at 36 shillings. Is it a good entry point that someone can still get in?
Yeah, thank you. I think 36 is a bit stretched from a valuation standpoint. I think it's a bit on the high side. However, from a sentiment point of view, it could be low, because there's a lot of news that is coming on board about the business, announcements that are positive for the business, and this will definitely have that. Investors will try to price in that kind of sentiment. For example, last week I think they talked about a system, a new system that NSC will be running on, powered by Safaricom. This is definitely positive for the business. And then the prior weeks we have seen a lot of news about product innovation, new products in the pipeline and the like. So you have all these news that there would be there's a lot of moving parts, but they create sentiment on a short-term basis. So from a valuation point of view, as I've said, it's a bit stretched, but sentiment for the stock is still very high. And if the pattern that you have seen in terms of foreign investor flows into the stock continues, then it could extend much further than those levels. Back to you, Daniel.
Sylvia Omulo is asking, under what circumstances are bids at bond auctions rejected if the target amount sought has not been reached? Churchill?
Thanks, Sylvia, for the question. Ideally, when the fiscal agent comes to put an auction, place a primary bond auction, I think at the back of their mind, they have a certain level of bids or the yields that they are comfortable that will come out of that auction. So the way they look at how it happens is based on, say, from the last week's auction, we had 42 billion of bids that were placed in, and then they rejected 10 billion of that. So they look at the aggressive bids. So those aggressive bids, the yields are higher than what was at the back of their minds. So they somehow reject them, and then we get to the levels whereby, in as much as they are not able to get the 50 billion, but they still are rejecting the bids. Also, that now perhaps leads to speculation that there might be a tap sale or there might be a new sale that might happen. So with a tap sale is that they will, because they have accepted that 2 billion, they were seeking 50 billion. So that difference, which is around 18 billion. So they say that they are opening a tap sale with an amount of 18 billion, first come, first serve, whereby the yields that have been issued from the primary bond auction becomes the yield that an investor who is participating on the tap sale will accept. So we saw that one was 11.784%, the other one was 12.58, thereabout. So as an investor, if you're coming into the tap sale, you have the yields already preset. So you just put in your bids amount that you want, or that's the first option. Or they might either reopen those bonds, or so it's now people bidding afresh, but with at the back of our mind, they're seeking 18 billion. So ideally, the rejection of bids stems from the fact that there's a level of yields that the fiscal agent is comfortable to accept, and then they just reject the bids that are quite aggressive. I think that has answered the question. So back to you, Daniel.
Thank you very much. Ian Wangai is asking, with the government proposing to raise the minimum alcohol package to 750 ml, EABL has said it will cost them 14 billion in order to accommodate these changes. Also, with the smaller packages, it makes huge sales for the brewer. What's your take on this, Gerald?
Yes, thank you, Ian, for the good question. I think, yes, the impact is, as they have mentioned, about 14 billion. Definitely, that is a negative for EABL. And it ties in back, to what I just mentioned in terms of our recommendation on EABL. One of the key risks is government taxes. And so this is still under discussion. There's a lot of pushback from EABL because that impact is quite large on them. However, if this sails through, then we'll have to do some adjustments here and there in terms of revenue expectations and the expected impact on the business. But however, on a long-term basis, I think the effects would fade off because most of the markets and most of the consumers would have been used to to the higher packaging levels. But on a short-term basis, of course, it is a negative for the business. So we are still seeing the discussions with Parliament, how they are going to be, and see whether this will sail through. Daniel?
Thank you very much, Gerald. Mathew, there is a question for you here. Maybe you can explain more about Bitcoin and the halving, and should we expect it soon? Like, what is the future, in short, of Bitcoin?
It's quite interesting, especially when it comes to Bitcoin, with only like 21 million coins outside there. And you see, for the past few days, we've seen Bitcoin jumping all the way up to 41,000. Actually, we're talking about $40,272, up by a very big percentage. So with Bitcoin, I think we can't base everything on technical analysis for Bitcoin. We have to look more on the fundamentals, because right now, what I'm thinking of, this is really very volatile. And here's is outside there in the market that you can't really talk of a backup, like an asset backup or asset backed kind of a financial instrument. I think it's all about supply and demand on this asset, on this I can't say an asset, this coin. So I think what we have to watch out and there is on the interests of investors. If investors start getting in, then of course it's going to be a different ball game, because it's like, of course, with the rise of value now, we have people getting interest. Like last week, we had the micro strategy trying to come up with offer a playbook on how the corporate can adopt the Bitcoin and how they can get in. Of course, talking about, of course, looking to big management funds, and if they get in, then of course a different ballgame. So for the Bitcoin, I think it's more of the fundamentals. Let's keep watching on it. But when it comes to technicals, might not be quite reliable. But again, it's something which is here to last. Keep watching the space. Of course, now even the Ethereum is catching up, and it's moving all the way from 1,630s, moving upwards, maybe targeting 1,700s. And it's really a space that we need to watch. That's what I can say for now.
Okay, thank you very much. John Kamau is asking, in this week, what are some of the good entry points in terms of shares? Gerald?
Yeah, I think that is not very clear in terms of entry points, because almost each stock, you can discuss each stock with its own entry points. However, for the key stocks that we are looking at this week is the EABL. I think last week, as we mentioned, was one of the top gainers. We still believe there's some value at current market prices. And then we also had an eye on the Kabasit BOC merger deal. I think we are urging investors to be cautious because of information last week about some delays in getting some of the documentation, for investors to ultimately give approvals. So for this week, those are the two stocks that we are looking at. Daniel.
Thank you. Julian Muga is asking, on the bonds, why can't CBK accept the high bids but advise the investor on the reduced percentage, so that the investor does not go through the tap sale or secondary market as target is not met in the first place? Churchill.
Wow.
I think this is about
the
yes?
bonds. Yes. So how I can do it? Let me just there's a kind Excel sheet that I've quickly prepared. Let me just share. Okay, can you see my screen?
Yes, you can.
So so this is so we have a bond that has been placed out, whereby the bids are coming to 40,000. This is just an example. And then there are 4 people who placed their bids. Each of them, we just use that all of them, they bid 10,000 of these. So the total amount was 40,000. And then you can see the received bids, whereby one person bid 12%, another 12.1, 12.2, 12.3. So the average of all the bids that came in was 12.15. So this is basically the average of all these bids that came in. Of course, they weight the bids that came in. But this is just for it's just a simple example. So whereby it's coming to 12.15%. Accepted bid. So this so that this 12.3% of the bid was quite aggressive. So they just eliminated this bid entirely. So they have 3 bids that were here. But you see that the accepted bid, the average of the 3 bids is coming to 12.1%. But you see that there's somebody here who's at 12.2%. So this 12.2% is what is called the cutoff yield in this auction. But the average is 12.1%. But you see, some person will get it at 12%. Somebody who is quite successful enough to just enter in is coming in at 12.2%. So you find that the price this person 12.2% is paying could be less than the price that the person who bid at 12% is coming in. So there's usually there's a soft spot for an investor, if just to preempt the question that Julian has posed, what is the right yield that somebody can come in? So there's usually a soft spot. You can't really pinpoint where it will be, or what is the aggressive bids that will be eliminated. So one trick, okay, not a trick, but one strategy that some people do if you really want to get into the bond is to stagger your bids. You can have a bid at 12%, say you have 1 million. So you can say 200,000 at 12%, another 200,000 at 12.1, like that, so that you are sure that at least you will be successful. So that's one option. Other option into the non-competitive bids, whereby the bid that will be accepted will be at the average accepted bids that the CBK will give out. So now to answer your question, I think 2 ways: stagger your bids or to get into competitive rates. But for non-competitive bids, it's capped at 20 million. So that is just looking at the small retail, or rather the retail investors. But if you are an institutional investor, or if you are the amount that you want to get into that auction is higher than 20 million, now you'll have to somehow stagger your bids, just to answer your question.
Thank you very much, Churchill. One last question from Richard Mwangi. Is TPS a good bet now that hospitality industry is picking up after the pandemic? And is it a good idea to start buying KPLC for long term? Gerald?
Thank you, Daniel, and for the good questions. For TPS, I wouldn't comment much about it because it's not one of the key stocks that we actively follow. However, if you look at the industry generally, last year was pretty bad. Recovery is still quite slow this year, and the effects could be there for some time. There's a lot of changes that have happened that could take quite some time, in terms of its effects on the industry. Most people right now are working from home. We don't expect that reversal, a complete reversal of that. So, such kind of events or social places could have some impact that may be a bit long lasting. The other question was about, oh yes, KPLC. Yeah, if you look at KPLC currently, the market capitalization is about 3 billion. That is multi-ton. It is, if you look at the revenue compared to the revenue about 100 billion plus. So it even doesn't make sense that kind of to have that kind of valuation. However, it reflects the circumstances of the business right now. I think there's an expectation of a loss for full year 2020, and the challenges that the business has been going on still there. There's been some positive pronouncements about fixing that, but that will definitely take a bit of some time. The government is still quite keen in terms of electricity generation, and you know that KPLC tends to bear the risk of all the power that is being generated. So power is there already. Right now we have excess capacity over and beyond the reserve capacity, and you'll find KPLC still having those challenges because the economy is not able to absorb all the capacity that is being generated. And when you hear government is talking about an additional 2,000, 3,000 megawatts, then it means there's going to be some problem in the future. So while the valuation is there, challenges are still there, and I think that is what investors are definitely pricing in. And whether the price will rise is anybody's guess. I think for almost 3 years now, we are talking about KPLC as a speculative stock, and I think it's still quite speculative because valuations is there, but challenges are there. Whether it will rise is anybody's guess. But if going forward performance improves and there is a look at the industry in terms of generation, matching generation and consumption, then I think the business is on a good, will be on a good trajectory. But that is not clear as at now. Daniel?
Okay, thank you very much, Gerald, Churchill, and Matthew for your presentations today. Now, if you missed part of the presentation or you joined midway, don't worry, as we will be sending an email with the link with the link of this presentation on which will be available on our YouTube page. Churchill, you have something to say?
Thanks, Dan. We're coming to the end of this week's presentation. And before we go there, I think let me give the floor to Gerald. He has an announcement to make. So Gerald. Gerald,
oh, sorry about that. Yeah, so thank you, Churchill, Daniel. So today marks the last presentation and engagement with you on this weekly webinar. So I want definitely to thank everyone, beginning with the management of the company for the opportunity to work with them for 4 years plus now. My colleague Churchill has been a great guy for these 4 years. We have worked together, and I couldn't be much happier within the research team over this time. And then the team that facilitates these weekly webinars, Damaris, Daniel, Dora, you guys have been doing a very good job in terms of facilitating this and bringing on board the retail clients. And also to our guest speaker who has been with us for the first time this year and last year. I think I've learned a lot about the global markets. I think one of the key things I remember about him is revenge trading, in the Forex markets. That will always be a standout for me for a very long time. So to our participants, it has been an absolute pleasurable and enjoyable, and a learning experience over this time, because you'll find that through these engagements, I also learn a lot, and not just me, even the entire team learns a lot about the investors and what their needs are. So continue engaging the team, continue supporting them, continue having them, give them your questions and your worries, and they'll be able to also improve on their end, and also be better at addressing your investments need. So I still be part of the Genghis Weekly webinar community, but now as a participant and not as a panelist going forward. And I sincerely want to wish you all the best in navigating the now normal. That is the theme of our playbook. We are living in turbulent environments, investment environment, financial environment. And I think for investors, there's a lot that they can explore in terms of investments, not just in equities and fixed income, but also across global markets. And given that, we are now, the pandemic brought about, the global village much closer to ourselves. I think we can be able to look at investments from a global perspective and have access to some of the assets that are not available locally. So for now, thank you very much all, and have a good week ahead. Back to you, Daniel.
Thank you, Gerald. I can admit that you have been a key cog in the research team over these years, and you are one of the analysts I know in the industry who's well-rounded. You've covered numerous sectors, be it banking, manufacturing, be it cement, be it whatever you name it. Gerald is quite all-rounded, and it's quite a big hole that you're leaving. But I'm sure that you are creating an opportunity for somebody else even to come in, as you also saw, into the next level. So what I can just wish you is all the best in your future endeavors. I know we'll meet. We know that who knows how the world will, what the future beholds upon us, and even for the participants, they know that you have walked them through on a weekly basis, and they feel that comfortable just getting through with your recommendations. So I'm seeing the comments just coming in. Yes, somebody will come in the next few weeks, but Gerald, we just wish you all the best. So let me stop it here before I become emotional. Men can be emotional. I know that we are 1 week to Valentine's, we can be emotional, but all the best, Gerald, in your future endeavors. So back to you, Dan. Yeah, Dan.
Yeah, thank you very much, Gerald. I don't know what to say. And I think after this webinar, maybe we may need to talk, but it's okay. We have to accept and move on regardless. Mathew, you had something to say?
Yeah, real quick. Thank you again for giving me this chance, even after the time is not on our side. But Gerald, I thought it could have been a little bit more during this presentation with you, but well and good, man. You got to. I don't know what to say. Anyway, so what I wanted to talk about is this question where Kama asked about Chinese or American stocks. Just get them on the platform. We have the global stocks there. You can take advantage of them. Once you register to that platform, you can get all those stocks ready for you to invest on. Just that's what I wanted to mention. And again, something, if you really want to catch up much of this information, you can again speak with Genio here. You can get the links where you can join on our Telegram channels. You can get a lot about our partnerships, again, those type of things. Thank you so much, Daniel.
Yeah, thank you very much, Mathew, Churchill, and Gerald once again. And it's on this note that we end this presentation. Should you want to now action this knowledge and information that we've shared through the presentations that we've had, you can maybe start by opening a trading account or a money market account for those who are those who are less on the risk side. And also through our partnership with Fx Pesa, Genghis clients are able to open accounts with them and be able to trade on the international stocks. And we hope to see you next week. And Gerald, as you transition to a panelist, a member from a panelist, we hope to also see you in the next webinars as a member. Thank
Gerald,
you very much.
Don't ask us tough questions.
Yes, don't ask us tough questions, and bring your insights from the outside world. Thank you very much. We hope to see you next week. Goodbye.